Hey, this is Yossi. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to discuss 3 new opportunities to buy the dip in the REIT sector following second quarter results. As usual, the market is quick to overreact to quarterly results, not understanding that real estate should be priced based on decades of expected future cash flow, and therefore the impact of a bad quarter or even a bad year really shouldn't be that significant on REIT valuations. Even then, it's not uncommon for REITs to sell off 5, 10 or even 15% following a bad quarter, and I think that this is simply because most investors are very short-term oriented. This can lead to interesting buying opportunities for long-term oriented investors like myself, and today I'm going to discuss 3 such opportunities. The first buy the dip opportunity are the Series C preferred shares of Gladstone Land. Its ticker symbol is LANDP. Gladstone Land is a REIT that specializes in farmland investments, and it has had a few tough years because on the one hand its interest expense has gone up, the REIT has quite a bit of leverage, and at the same time it has faced declining demand for some of its farmland properties. This has led to declining cash flow, which is now threatening its common dividend. In fact, on the most recent earnings call, the management seemed to hint at a potential dividend cut later this year. Here's what they said. We are maintaining the dividend at its current level for now and will reevaluate it in the coming month as we gain more clarity on 2025 harvest results. The key words "for now" and that we will reevaluate in the coming month lead me to think that they are likely to cut the dividend in the near term. This is bad news on its own, as no one likes a dividend cut, but on top of that, the second quarter results came way below expectation because the REIT just recently converted a bunch of its fixed farmland leases into operating partnerships, by which the REIT will now earn a larger variable component in Q4, but smaller fixed rental income payments in every individual quarter. So because of that, its Q2 earnings dropped quite a bit. We should see a bump up in Q4, but even then the market is not looking that far out, and as a result of all of this, the share price of the company dropped quite a bit following Q2 results. We are not interested in the common equity because we think it's quite risky, it has quite a bit of leverage, and it may present further downside as it cuts the common dividend in the near term. However, we're interested to see that the preferred equity sold off along with the common equity despite being much better protected, and as a result now it's trading at a 25% discount to its par value, and it's offering a near 8% dividend yield. That's so cheap that the company just recently initiated a buyback plan to repurchase some of its preferred equity. Here's what they said. After a thorough analysis and consultations with our board of directors, we are announcing another share repurchase authorization as part of our capital allocation strategy that we believe is in the best interest of our shareholders and our business. We believe that the current market conditions provide an attractive buying opportunity for our preferred stock, and using our capital to repurchase our preferred shares at the appropriate prices represents strategic use of our capital. And I think that this buyback plan only improves the risk reward of the preferred equity even further, because it should support its share price going forward. They are planning to buy back up to 55 million worth of its preferred shares, which is already quite illiquid to start with, and therefore we think that this might mark the bottom in the preferred share price. Last time that they announced a similar buyback plan for the preferred shares, they rose quickly to $22, yet today you still have the opportunity to buy them at just about $19. It's very rare to get to earn a near 8% dividend yield from farmland investments, which are typically quite low yielding investments, and this is especially true given that we have a senior positioning to the common equity, and that makes the risk reward very attractive. I think that as interest rates are cut over the next year and conditions improve for Gladstone Land, as the market sees that it's earning a larger variable component in the later quarters of the year, we will see a recovery in the share price, potentially even earlier if the company steps up its buybacks, and so we should see additional upside in addition to the 8% dividend yield. For this reason, I think this is the best way to invest in farmland today, and we bought the dip at high yield landlord. Hey, before I go into the second buy the dip opportunity, can you please do me a huge favor and click the like button, subscribe to your channel if you enjoy this type of content. Thanks so much in advance. The second opportunity is BSR. Its ticker symbol is HOM.U in Canada and BSRTF in the US. This is another REIT that dipped following its second quarter results, and to be clear, it's not just BSR, but it's the entire apartment REIT sector that took a hit. Its results were not particularly bad. In fact, they were roughly in line with what analysts like us were expecting. However, the market appears to have expected, or at least hoped for an acceleration in rent growth to already happen in the second quarter of this year, the management made it clear that this likely won't be the case and that instead this acceleration should take place in 2026. That was enough for all these apartment REITs to sell off. Waiting another 6 months was just too long for the market. But if you're long-term oriented like us and can think like a landlord and can look a few quarters out, the outlook is now very bright for Sunbelt focused apartment REITs like BSR. According to Camden Property Trust, which is one of the biggest Sunbelt focused apartment REITs, rent growth should accelerate to 4% in 2026 and up to 5% in 2027. This is simply because the new supply hitting the market should drop significantly in 2026. Already now, developers have mostly stopped new development projects simply because the cost of construction is too high to make new projects economically feasible. The rents simply are not high enough for these projects to be profitable, so they've stopped new projects and the supply should now drop going forward as the market has gotten oversupplied. Therefore, the fundamentals should improve significantly in 2026 and the balance of power should go back from the tenants to the landlord, leading to significant rent hikes. I think that BSR should be one of the biggest winners from this drop in new supply, given that it's very heavily invested in the Texan triangle of Houston, Austin, and Dallas. These are rapidly growing markets, its properties are still very affordable, and I think they should be able to push for quite significant rent hikes in the coming years. On top of that, BSR recently sold a major portfolio of apartment communities to AvalonBay, which is another apartment REIT, and it's today in the process of redeploying these proceeds into other properties that are still in their lease-up phase and also in buybacks, which should be highly accretive to its FFO per share. Even then, following its recent dip, the company is now trading at a 25% discount to its net asset value. We think that as rent growth now accelerates going into 2026, even as interest rates are cut at the same time, we'll see the net asset value of the company surge to higher levels and the discount will also simultaneously close down, which could lead to 30 to 40% upside from here. While you wait, you're earning a 4.3% dividend yield that's paid on a monthly basis, and therefore we think that the risk reward is very attractive coming from a defensive apartment REIT. Finally, the third buy the dip opportunity that I want to highlight is International Workplace Group, ticker symbol EWG. Company is not officially structured as a REIT, but it essentially functions as if it was one. In case you're not familiar with EWG, it's the biggest provider of co-working place in the world. It's much bigger even than WeWork, which is better known, and it dropped by about 10% following its second quarter results. We are very bullish on the stock because today heavily discounted, trading at just about 10 times its free cash flow, even as we expect very rapid growth over the coming years. The market did not like that the company cut its 2025 profit guidance, but this is primarily because they are choosing to more heavily reinvest in growth at the expense of their near-term profitability. To be more specific, they expect to significantly scale up their partnership sales team this year, and this will add an incremental $15 million of cost, and as a result, they will not hit their profitability guidance that they initially set last year. But this should also accelerate the growth in new signings, which would then result in greater profits over the coming years. Therefore, they are essentially trading near-term profitability for long-term profitability, which is a trade that makes perfect sense for them given the huge tailwinds that their sector is today enjoying. As we explained in a recent update at High Yield Landlord, we think that the AI revolution is going to be a huge tailwind for EWG and the flexible office space in general. And that's simply because if you're a major office tenant today, and let's say you have 100 employees in your office, because of the AI revolution, you cannot know today if you will still need those 100 employees in just a couple of years from now. Perhaps in 2 years, you only will need 70 of them. And because of that, you won't be able to now sign another 10, 15-year long lease as they have typically done in the past. Instead, I expect a lot of companies to request much more flexible terms, and they will go for co-working offices such as those of EWG. As a result, I expect a growing number of office landlords to turn larger components of their buildings into flexible office space, and they will then partner with EWG to manage it for them. EWG is now preparing to accelerate the signings of these new partnerships by increasing the size of its sales team. This signaled significant growth ahead, and yet the stock dropped anyway because the market is very short-term oriented and no one likes a cut to near-term profitability guidance. The company is now taking advantage of this dip to aggressively buy back shares. This is evident if you look at their recent filings. They are generally doubling down on their share buybacks. The company also reaffirmed a midterm guidance of reaching $1 billion of EBITDA, and if they come even close to that, I think that the stock will surge to a lot higher level. Therefore, I think that the investment thesis for EWG actually got even stronger in the last quarter, and yet you can now buy it at an even lower share price. This is currently our single largest holding at High Yield Landlord, representing 11% of our core portfolio, and we're investing so heavily in it because we think that will ultimately be one of the biggest winners of the AI revolution, and the market has completely overlooked this angle so far. We think that has the potential to become a multi-bagger over the coming years, and we recently wrote a detailed report on this topic that you can read at High Yield Landlord by taking our free trial, first link in the description of this video. This will also give you immediate access to our full portfolio holdings, all our trade alerts in real time, and our best research. Again, it's a 2-week free trial, you won't be charged anything in the first 14 days. First link in the description of this video. Otherwise, if you enjoyed this content, please consider clicking the like button to support our channel. Thanks so much and see you at our next one. Bye bye.